If you are looking for a way to make some serious passive income, look no further than the dividend. How are you guys doing today? My name is Apple. Today we are filling in the financial gap between schools and the real world. And today what we're talking about is dividends. In this video, we're going to be covering what dividends are, why companies pay them, how you can use them to build wealth, and if you stick around to the end, I'm going to have some tips on how you can best utilize dividends in your investing strategies and in your life in general in order to maximize the effect that they have on your wealth and on your financial freedom. So I think we should just hop right in and start talking about what dividends are. So let's do it. What is a dividend? A dividend is a periodic payment that companies make to their shareholders. And okay, so let's break that down. So periodic payment. How periodic is periodic? Well, generally dividends are going to be paid out from a company, a publicly traded company, to their shareholders, so people who hold stocks in that company. So Apple, if I hold Apple shares, Apple pays dividends. And Apple pays dividends every quarter. So every quarter, every 3 months, quarter of the year, every 3 months, Apple is going to write me a little check for some money, and that is going to be a dividend that I get just for holding on to shares of their stock, which is pretty cool. So I can rely on them writing me this check every 3 months and know that as long as they keep paying that dividend, I'm gonna keep getting that check in my pocket every 3 months. So that is pretty cool, pretty nice passive income right there. So dividends are generally going to be paid either every quarter, so every 3 months, or every month in some cases. In some cases, they're only paid out once a year, but that's pretty rare, as again is being paid monthly. So it's usually quarterly. Most companies that do pay dividends do pay them by the quarter. So every 3 months, you are going to be getting a paycheck from that company just for holding on to their shares. And these dividends, these checks that you're getting written out, are measured in yield or dollars per share, so DPS. So first of all, what is yield? So dividend yield is comparing how much you are getting paid in that dividend to how much the share price is. All right, so let's give a little example. We're gonna say company X. We've got company X. Company X pays a dividend of $1. $1. And company X's share price is $100. So share price is $100. So to calculate the dividend yield, all you do is you divide the dividend by the share price. So 1 over 100 equals 1%. And yeah, dividend yield is measured in percent. So company X's dividend yield is right there at 1%. They are paying a 1% dividend yield. So boom, that's the yield. But dividend is also measured in DPS, or dollars per share. So again, the share price, $100, and the dividend is 1. So the dollars per share, so you own 1 share, you're being paid $1 in that dividend. So the dollars per share would be $1. So they could either say that their DPS is $1 or their dividend yield is 1%. These both mean the same thing for company X. So you need to look out for how it's being measured and definitely try to contextualize that so you know what actually you're gonna be getting paid. And I should mention that this $1 is an annualized dividend. So if they are paying out their dividends quarterly, then their check that they're going to be writing you every quarter for owning 1 share of company X is going to be 25 cents, because 1 divided by 4 quarters equals 0.25. So you're going to be getting a quarter on each of your 4 dividend checks. So that $1 is your total amount of dividends throughout the year, and that is how yield is calculated. All right, so now that you understand what a dividend is and how it is measured, how it is paid out, who is going to be giving these dividends, it's going to be large, stable companies. So companies that know that they have solid earnings coming in and will continue to have solid earnings coming in are going to be paying out dividends because they know they don't need to be pumping all of this money back into their own assets and their own production. They know they can afford to give some of it out to shareholders. So let's give some real world examples of companies that actually give out dividends. We're not doing company X anymore. We're going to be talking about two big companies that you have definitely heard of. One of them is called Microsoft, and one of them is called Apple. So, all right, Microsoft pays dividends and Apple pays dividends. Let's look at how much dividends they pay and how that relates to their share price. So we're going to break this down real simple. So as of me recording this video, Microsoft's share price is sitting at about $88. So they have about $88 share price, and Apple's share price is sitting at about a 156 and a half. So 156 and 50 cents on Apple. Microsoft's got a yield of about 1.9, so yield of about 1.91%, and Apple's got a yield of about 1.61%. All right, now let's look at DPS, so dividends per share. With Microsoft, if we multiply this 1.91% by 88, we're going to be getting our dividends per share because you're getting that much. You're getting this yield per that many dollars. So that's going to come out to $1.68 is about their dividends per share right now. Now for Apple, if we multiply our 1.61 by our 156.50 for our DPS on Apple, we are going to see a $2.52 dividends per share. So that is our dividends per share for Apple and Microsoft. And as you can see, their yields are pretty similar, but because the price of Apple is about twice as much as the price of Microsoft, that yield is significantly higher than this one, or those dividends per share rather are higher than these dividends per share. Even though Microsoft does have the higher yield, they've got the lower share price, so that is why that happens. And obviously, Apple and Microsoft, pretty big companies. Apple is the largest publicly traded company right now. It is surely approaching $1 trillion market capitalization. Maybe by the end of this year, we will see. But yeah, Apple, huge company. Microsoft, also giant company. And they are paying out some pretty solid dividends. And I will say that for a big company, a dividend yield really anywhere from like 1.5% up to like 3.5% is pretty standard. Anything above that is kind of out of the ordinary, and anything above like 6 or 7% is you should really be questioning if they can actually afford to be paying that dividend. I'll just say that right now. We can get back to that later. So why do companies do this? Why would a company decide, okay, I'm making a lot of money here, let me just pay some of it out to these people who are holding shares of our company? Why would a company decide to do that when they could just take this money and put it in their pocket or reinvest in the company or something like that? What would make them make this decision? And one of the first reasons that a company might choose to do this is to incentivize their shareholders to stick around. So with a big company that is not experiencing some huge growth, like some serious growth companies, like startups and stuff like that, there are not going to be a ton of investors that are going to be like, okay, I just want to park my money here and not get a bunch of returns and just sort of let it sit and be sort of slowly growing. I would rather put it in a company that might explode in growth and has a ton of growth potential behind it. But with these big companies, what they have decided to do is to incentivize people to stick around. They're like, all right, if you hold our shares, we're going to kick you back 1.5% to 2% of a portion of our earnings each quarter, just to be like, thanks for sticking around, thanks for holding our company and for being shareholders, essentially. That is what they are thanking you for, pretty much. Next, that reason that they would decide to do this is to show that the company is doing all right and expects that they are going to keep doing all right. So if they can afford to pay out dividends, they are clearly doing something right, and they are clearly getting a decent amount of earnings, because if they weren't having money coming in, they would not have the money to be paying it out to all of their shareholders. So having dividends Having a dividend-paying company really shows that this company is at least fairly stable in terms of their earnings and their money coming in if they can afford to consistently, keyword here is consistently, pay out dividends to their shareholders. So you do want to look at that history behind a dividend to see if it is actually something that this company can maintain over the long term, if it's something that they have been maintaining for years and years, or if it's something that doesn't make financial sense for them and it really is something that is inconsistent at best. And the last reason that a company might choose to pay out dividends is if they don't need to reinvest all of their earnings into their business, if they really have it up and going and there isn't a lot of additional assets or things like that that they need to be investing in, if they can really just afford to invest part of their earnings and send the rest back and have enough capital coming in to fund the business and have that extra left to pay out the shareholders for sticking around. And some examples of companies who do currently pay dividends are, like we said, we've got Microsoft, we've got Apple, we've got Waste Management, we have got Wells Fargo, we have got Verizon, and all of these companies, they are household names, they are big companies that you have heard of and that you probably used on somewhat of a regular basis. So those are the companies that are paying out dividends, and lots of big companies are. So next, why would a company choose not to pay a dividend? Why would they decide, you know what, we don't need to do this. We don't need to pay our shareholders money. They can figure it out themselves. Why would a company choose not to pay out dividends? Well, firstly, if they're not looking for rapid growth. So with a startup, when you are first getting started, you want that growth. You want growth as fast as you possibly can. You want to get big, and you want to get big fast. But with a big company that's already established and already has that solid market share, you don't necessarily need to try to be pushing the boundaries of your competitors, of your market share. If you are already huge and established and have a solid customer base that is bringing you in solid earnings every single quarter. Sometimes that is just not necessary with a big company because you're already so well established. You don't need to be funneling all this money into expansion. So that is the first reason. Another reason that companies would choose not to put out dividends, and the next reason that a company would choose to put out dividends, is because that they believe that they can provide more value to their investors by investing this capital themselves into their business, into growing their business, acquiring assets, acquiring competitors, than their investors would be able to get from just receiving this dividend as a monthly payment. They think they could drive their share price higher by doing these things with their capital, then sending it back to their shareholders. So that is the second reason why a company might choose to not put their money into dividends. And the last reason would be that they don't want to have to take it away at some point. So if a company is not feeling totally stable, not feeling like they have these consistent earnings coming in, they don't want to start putting out a dividend and have it going for a little bit. And then times get tough, money gets short, and then they have to take it away. Because if you have to take your dividend away, that is not good for your company at all. GE had to take their dividend away and their share price fell 8% that day. So you really don't want to take a dividend away once it's there, once investors think they can count on it, which really you can never count on a dividend 100% because a company can take it away at any point. They don't have to have any reasoning or give you any heads up or anything. They can just take away that dividend. So you never want to be totally reliant on a dividend, but companies don't want to start paying a dividend that they have to then reduce or take away, because that will make shareholders very angry and very worried about the future of the company and probably drive the share price down pretty significantly. All right, so who are some companies that don't pay dividends? Well, some of the big names that don't pay dividends are Facebook, Amazon, Google, and Tesla. So these guys do not pay dividends at the moment for any combination of reasons. Might be some of the ones we mentioned above, might be some of the ones just not mentioned here. There could be a multitude of reasons. Those are just the three biggest reasons I see why a company would choose not to pay dividends. With Tesla, obviously they're not paying dividends because they are not turning earnings yet. They are not generating money to be net positive anyway, so they don't have the money to pay out to shareholders without going into more debt. So that just doesn't make sense financially at all. But the rest of them, they just choose to reinvest their money themselves without paying it out to their shareholders. All right, so how can you use dividends to build wealth? Well, let's look at a couple examples. There are two main ways that you could use dividends yourself in order to build wealth. You've got two real options. The first option is to take the dividends each month and use them as a budget to live on. So how this works is, all right, let's say you invest $1 in company X. So we've got company X again, company X. Company X pays out a 3% dividend yield, okay? So they got a 3% yield. Awesome. They got a 3% dividend yield, company X. So first year, first thing you're gonna do is you're gonna invest $1. So you invest $1 in company X, and each year they are going to be paying you out a dividend of a whole whopping $0.03. So you get 3 cents from company X if you invest $1 with them. All right, no big deal. 3 cents a year, you're not gonna live on 3 cents a year. You're not gonna live on 3 cents a day. But what if you invest $10? What if you say, okay, I'll put $10 in company X long term, and how much they're gonna pay you every year? They're gonna pay you 30 cents. So we're getting better, but 30 cents, still not something you can live on. Let's bump it up to $1,000. So you invest $1,000 in company X, $1,000 in company X stock, and you are getting paid out a whopping $30 a year. So not too bad at this point. $30 could get you through, could get you a nice dinner, or I don't know, go see a movie with your significant other or something. So you can get $30 a year if you're investing $1,000 into company X. Let's take it a step further. Let's say you invest 10 grand. 10 grand in company X. They're gonna be paying you out $300 per year. So now we're talking. You're getting $300, a $300 check every year for just holding on to company X and parking your money with them, in addition to the appreciation of that asset over time, which hopefully, if you're making a solid investment, it is gonna be going up in value over time. Let's take it a step further. Let's say you're gonna put $100,000 into company X. They are gonna pay you out $3,000 per year just for holding on to company X. Let's take it a step further. Let's say you somehow find the way to put $1 million. So $1 million into company X. They are going to be paying you out $30,000 a year. So as you can see, at this point, they're paying you out $30,000 a year, which is a very significant amount of passive income to be making just for parking your money with this company. Of course, $1 million is not very achievable for a lot of people probably right now. But as you get towards retirement and as you start wanting to stop working and start relying on your savings to be funding your lifestyle, being able to have $30,000 of passive income coming in every year consistently is a very, very valuable thing. And being able to get this out of a dividend is very, very helpful for retirement and for just not having to rely on that paycheck coming in and being able to rely on your dividends to fund your lifestyle. So that is one of the main reasons that I like dividends so much, is because you can really use them to fund your lifestyle if you get a solid investment in that company going on. But that is not my favorite way to get passive income from dividends. My favorite thing to do with dividends is called DRIP. And if you haven't heard of DRIP before, it's a pretty wonderful thing. I think you'll really enjoy it. It is called a DRIP, spells drip. And what we're talking about with DRIP is we're talking about a dividend reinvestment plan. All right, DRIP, dividend reinvestment plan. So what dividend reinvestment plan is, obviously from the title you can tell that you're going to be taking your dividends and you're going to be reinvesting them. Reinvesting them in what? Reinvesting them in shares of the company that is paying you these dividends to begin with. So if we go back to our company X example, we think back to our company X who's paying out a 3% dividend yield. If we had a dividend reinvestment plan going on, what we'd be doing is, say we had that $1 invested, they pay us a 3-cent dividend that first year. What we do is we put that 3 cents right back into company X, and we now have $1.03 invested into company X that will generate us a greater dividend next year. And this just compounds and compounds and compounds and really takes advantage of compound interest and allows our money to grow much, much faster than if we were simply taking out our dividends each year and spending them, or using them to do something else. If we instead reinvest our dividends, we are able to take greater advantage of compound interest, which I talk about a lot, and it's a very, very good way for you to build your wealth. You really take advantage of compound interest with a dividend reinvestment plan. And if you are invested in any companies that offer dividends, I would highly, highly recommend that you set up a dividend reinvestment plan, which I do with all of my dividend paying investments in my Roth IRA. I have dividend reinvestment plans set up for Apple, set up for an index fund, and it's very simple to do. All I had to do was flip on this little switch, and immediately when those companies send other dividends, the broker that I'm invested with, Fidelity, automatically takes that dividend and buys me back fractional shares of those companies. So I have fractional shares of Apple and that index fund that I'm invested in because of Fidelity just going out and spending all of the money that I got from that dividend on as many shares or as many fractions of shares as I can afford with that. So I really, really recommend a dividend reinvestment plan to maximize the effect of those dividends and allow them to really, really pile on over time. So by the time you do get to retirement, you are able to possibly follow that first example and have that greater capital available to be able to withdraw more from your dividends each and every quarter. All right, so lastly, I'm going to leave you guys with 2 tips on how you can best take advantage of dividends. And all right, so the first tip is look at length. All right, so my first tip is history. So what I mean with history is you want to look at the dividend history, the dividend paying history of the companies that you are invested in for dividends. So if you invest in a company that you expect to be paying you dividends, and that is one of the main reasons you're investing in them, first thing you got to look at is how long have they been paying these dividends? Have these dividends been rising? And how likely do you think it is that they're going to keep up with these dividends? So let's look at a couple companies. We'll look at Microsoft, we'll look at Apple. So Microsoft has been paying dividends for 14 years. They have been paying rising dividends for 14 years. So over the last 14 years, their dividends have consistently come in and gone up. So I think we can successfully rely on Microsoft to be paying consistent dividends over time. Now, Apple has only been having rising dividends for the last 4 years, but that's because they haven't been paying dividends for as long because they just recently started putting out dividends. So we can't have as much confidence there that they would continue those dividends. I see no reason why they would cease to produce those dividends just because they are such a big company, and I don't see any reason why they would choose to stop doing dividends. That just wouldn't make sense in my opinion, but you always want to look at the history behind a company's dividends and behind if their dividends have been going up, if they have ever cut their dividends, if anything has happened with their dividends that would make them not consistent in the future. And the last one, probably more important, is that dividends are taxed differently than capital gains. So with dividends, when you get taxed on your dividends, which you do because you get taxed on any income that you make, when you get taxed on your dividends, you're actually taxed at your normal income tax level instead of getting taxed at the capital gains rate. So with capital gains, there is a short-term and a long-term capital gains tax rate. So the short-term capital gains tax rate is the same as your income tax rate, which is the same as your dividend tax rate. However, if you take a long position and you hold a stock for more than a year before you sell it, then you pay a lower tax rate on that investment, a long-term capital gains tax, which is going to be taxed significantly less than your income tax or than your dividends. So with your dividends, you want to make sure that you know when you take these dividends out, when you're getting paid via dividends, you're going to be paying more tax on that than you would have if it would have come from just the rising value of your stocks in general. So that's definitely something to keep in mind, and possibly another reason that you might want to consider a dividend reinvestment plan so that your dividends are just rolled right into your investment and are part of capital gains that way instead of being taxed at a higher rate at that dividend rate at that normal income tax level. Anyways, that wraps it up for the video, guys. If you stuck around to the end, let me know in the comments below. Tell me that you stuck around, and I will be so stoked. I'll definitely reply to you, and props to you for making it all the way through. I really do appreciate it. If you enjoyed this video, guys, please do remember to leave a like. It really does help. It really boosts my self-esteem when I see all those thumbs up. When I see I got like 6 thumbs up, I'm like, wow, can't believe 6 people actually watched this and really liked it. That makes me so happy. So definitely leave a thumbs up and subscribe if you haven't already, because you do know that you want to subscribe. I know that you want to subscribe. You know that you want to subscribe. So, I mean, just go ahead and do it. And share this video with a friend if you got any value out of it, if you think that they could learn a thing or two about dividends, because they are a great way to be making passive income as a young person, as any person, to be honest. Anybody could benefit from dividends. So definitely share this with all of your friends, because I'm sure they could all benefit from dividends. I will see you tomorrow, and until next time.